What's going on, guys? Today we've got a great episode with Polina Pompliano. In this conversation, we talk about what's going on with Bitcoin, new regulation coming out of Washington, D.C., the rise of self-directed investors, and why professional athletes seem to be so enamored and successful by investing in Bitcoin. This conversation covers a lot of unique thoughts that talk about the long-term trends as to how we are watching capital flow in the market and why I think that retail investors keep beating institutions to various investment opportunities like Tesla, Palantir, Bitcoin, and others. Here's my latest conversation with Polina Pompliano. All right, Polina, what's the first topic?
Bitcoin is at $118,000. It's holding steady. Trump media bought $2 billion worth of Bitcoin, showing more support from the administration and making them the fifth largest Bitcoin corporate treasury. Interesting. And then SEC Chair Paul Atkins said on CNBC on Monday, it is encouraging to see public companies adopt Bitcoin and crypto as treasury reserve assets. What do we think?
Well, the Trump media company, which has Trump's name on it, but I don't think that he is heavily involved. I think he's like indirectly financially benefits from it. But I don't think that people should be surprised they raised billions of dollars to go buy Bitcoin. And then they went and they bought the Bitcoin. Everyone's like, oh my God, they bought Bitcoin. Like, what did you think they were doing? They told you they were raising the money to do it. Now, I think, if I understand correctly, when they raised the money versus when they bought, it's a pretty big price difference. Because I think they actually raised the money when it was closer to like 100,000, 105,000. Now they got to buy at, whatever, 115, 120. So, look, Bitcoin is a game where the longer you wait, many times you can get punished, but also it's a public environment, right? That there's certain rules, regulations, things in terms of the fundraising details, all that stuff plays into it. But I think that there's a lot of companies right now that are learning if you raise capital and you do not deploy it into Bitcoin, sometimes you will have to pay for that later on and you end up with less Bitcoin because the price can obviously move very quickly in a very short period of time. Great.
Last week was dubbed Crypto Week because we saw an unprecedented 3 crypto bills being signed. The first is the Genius Act, which creates the first ever federal regulatory framework for payment stablecoins. Then there's the Clarity Act, which helps determine whether digital assets are securities or commodities, resolving longstanding jurisdictional confusion around SEC or CFTC. And the Anti-CBDC Act, which bars the Federal Reserve from issuing a central bank digital currency, which addresses concerns about privacy and government oversight.
If I understand correctly, one of those got signed. The other 2 got approved in the House. Now they go to the Senate, and then the Senate has to approve it, and then they'll be
so only the Genius Act has
the Genius Act. Now, I will say, look, I don't care if you like Trump or not. If you're a 12-year-old young man and you have to go up on a podium in front of a room of people and talk about something called the Genius Act, the layup, finger roll joke is to be like, they named the bill after myself.
Oh, Lord.
He said that in the thing. So again, I don't care what your politics are. Like that was like just like layup city, and he did it, which is pretty funny. Now, with that said, I thought it was very interesting. Obviously, the bill getting approved, all of that signed, great. The White House held an event. What I found very interesting was they called out by name a number of entrepreneurs who run companies in the Bitcoin and crypto industry, including Paulo, the Tether CEO, was there. And so this whole like FUD of the largest stablecoin in the world is complete nonsense. Like he's in the White House getting called by name by the president of the United States. And they're talking about stablecoins are going to increase dollar dominance globally. Stablecoins are going to drive adoption of the US dollar globally. Stablecoins are going to become an important part of the traditional financial system. Stablecoins are the future. Stablecoins are cheaper and faster. All these things they're saying. And they got the guy who is running the largest stablecoin in the world, which is probably the single most profitable company in human history based on a EBITDA to employee ratio. So all the FUD, all the nonsense, like Tether is winning. Now, that doesn't mean that Circle or any of the other stablecoins are not doing well also. They're growing, they're getting adoption in their own areas. But I think that what we have seen historically is there have been people who have tried to say, oh, there's kind of an unregulated world, and then there's a regulated world for these stablecoins. What we are now seeing is no, there's a stablecoin world. And as we get clarity through this Genius Act, as we get the traditional banks start to participate here, like it is game on. And I go back and I continue to remind people, the US dollar is one of the best product market fit products ever created. Everyone in the world wants dollars. And so what you are going to watch is you are going to watch all of the challengers, Tether, Circle, etc. I'm not going to go name all of them. They have a head start because they got to get started sooner, but also they have momentum, they have assets, and they understand the technology because they've been building with it for a long time. The banks are coming. You are going to see JP Morgan, Bank of America, Citi, all of these banks.
That's because there's now regulatory clarity.
They could have done it before, but now it's like they're getting hit over the head by a 2x4 saying, hey, geniuses, get in the game or you're going to get disrupted now, right? And so I actually think that the regulatory clarity helps the challengers more than it helps the incumbents. Now, some people disagree with me on that, but it is now clear that the U.S. government is not going to stop these challengers. And so they have a massive head start and the banks are going to try. Now, if you're the bank, don't try to compete with the stable coin in the areas that stable coins are winning. Tether has run all around the world and gotten emerging market adoption of US dollars via these digital rails. Great. If you're JP Morgan, what are you going to do? You're going to go to Rwanda and try to get people to adopt a dollar? Or are you going to go to some obscure city or region in the world and try to get bottoms up adoption from people who, frankly, you previously have not banked? No. What you're going to do is you're going to say, we're going to sit in our fat cat ivory towers in Wall Street, New York City, and we're going to figure out how to use our size, our scale, our relationships, our customer base, and the current assets we have to carve a lane for ourselves. So the first thing that we're probably going to do is probably going to roll out stablecoins to our existing customers who happen to be quite wealthy compared to the average person around the world, right? It's something like if you're in the United States, I think that you are considered, if you live in the United States on a global basis, I believe that the average American is considered in the top 1% of the world.
Probably.
And so if you look at the customer base that these banks have, like they on a relative basis have a very wealthy client base, even for people who in the United States, you may not say, oh, they're super wealthy. So if you go and you roll out this product to them, now all of a sudden, every bank wire, rip that out. Why don't we use stablecoins? Every single kind of money transfer, rip that out. Replace it with stable. Like that's the opportunity set here. And guess what happens? If they're able to drop the cost and increase the speed of those transactions, people will probably do it more. And so that's where I think this is going is the banks are going to lean on their advantage. The challengers are going to lean on their advantage and they're going to meet somewhere in the middle. And that's where you're going to start to see M&A. That's where you're going to start to see like Tether is going to put a bank out of business somewhere in the world because Tether is going to be able to go cut off their potential customer base. And they are going to start to use these rather than have a traditional bank account. This is the future where this is all going. It is going to be hyper competitive. I would even argue might even be cutthroat. And part of the narrative against some of the stablecoin challengers was the big players trying to play dirty games and say, oh, they're unregulated, oh, they're breaking the rules, all that kind of stuff. But now that these companies have size, scale, and momentum, well, what happens when they start going after the bank's clients? And I think that's what you're going to start seeing now is you're going to see everyone, and I talked about it on a recent episode with the Wintermute CEO. Everyone, it's like elementary analysis. The big financial institutions are going to come into the digital asset space. Great. You know what a big theme is going to be over the next decade that is not a lot of people talking about? These young challenger companies, the crypto companies, the Bitcoin companies, they're coming to eat the lunch of the traditional firms. And guess what? Some of the big firms will take business from the smaller firms and use it as a growth path. But some of these challenger firms are going to disrupt and probably put out of business some of these legacy firms. But that's how the actual disruption occurs is you get them fighting with each other. Everyone's talking about the big guys going into the digital asset space. Not a lot of people talking about the digital asset guys going to the big space. And if that starts to happen, you're going to see a lot of backlash. You're going to see a lot of dirty games get played because no one wants the crown jewel, the mothership of their legacy business put at risk. But here they come. The cavalry is coming now, and their businesses that they've enjoyed for a long time, they're going to come under pressure because the challengers have better technology. It's very obvious that users around the world, that's what they want to use. Yeah. They'd rather do that than do wires or any sort of bank transfer.
That's really interesting. And what I find fascinating about these acts is that they're like it's bipartisan supported, right? Like,
of course. Like I said it on CNBC a couple weeks ago. Politicians are not dumb. They play dumb sometimes. They pretend like they don't know what's going on. They understand that the will of the people will eventually be heard.
Yeah.
Are you really going to be a politician who expects to be around for a long period of time? Now, if you're an older politician and you got a like kind of cemented base and you live in an area where it doesn't matter who shows up, you're never going to get voted out. Do whatever you want. Of course, you could be anti-Bitcoin, crypto, whatever. But if you're relatively young, middle-aged or below, and you want to have a long career in politics and you're on the wrong side of this topic, it doesn't take long. Look at any survey. Young people and American citizens want these technologies. If you want to have a long career, you better not attack the area that not only people want the technology, not only is growing very fast, but guess what? Whether you like it or not, these people have money and they start to put the money to work. Go look at what Fair Shake, this PAC that they put together. It's like one of the largest PACs in all of politics. The president of the United States ran, and one of his key components of his entire approach was, I'm going to protect your right to participate in this industry. How many companies, corporations, et cetera, now are pouring resources, time, money, energy, employees, strategic kind of initiatives, et cetera, into an industry that they previously thought the regulators were preventing them from participating? This is the game going forward. And so if you're a politician, you're looking at the data. You understand, I got to be on the right side of this thing. And that's why you're getting the bipartisan support.
And let me ask you this. Trump said that crypto has, quote, made our dollar look really good and strong and powerful. It's good for the dollar and it's good for the country. What does he mean by that? Just because like people are going to be using stable coins to transact?
Here's a real example. Let's say you live in Lebanon, right? Or any other country that has experienced the devaluation of their currency. Sometimes it is market-based, where over time people just say, hey, this is not nearly as valuable, et cetera. Other times, there are literally policy decisions where central banks or governments will intentionally devalue their currency themselves. Mm-hmm. How many stories do we have to read about somebody goes to sleep, they wake up, and all of a sudden their currency's 30% devalued, and they literally saw 1/3 of their savings disappear overnight.
Yeah.
Right? So if you live in that country, you say to yourself, well, in the Western world, in the United States, I have a savings account, I have a checking account, I have a brokerage account. So guess what's going to happen in the digital world? You're going to have the same thing. Some of your money is for saving, some of your money is for spending, and some of your money is for speculating. In that world, Bitcoin has done a fantastic job of becoming the savings technology, the store of value. You buy Bitcoin, you don't sell it. Bitcoin over a long period of time continues to go up, and for the foreseeable future, that will continue. The brokerage equivalent, the speculation, you can go buy stocks, you can go buy all these crazy coins. There's plenty of speculation going on, including to the fact that I think the market maybe has become somewhat of a casino. But what is the asset that I can buy in the digital world that I can use with the same speed and cost of digital assets, but I should use for spending? Well, I don't want to spend my Bitcoin because Bitcoin's going to be worth more in the future. Why would I spend something today that's going to be worth more later? The economic incentive is against me. I'm incentivized not to spend my Bitcoin. So it's a savings technology right now. The spending is I want to spend something that'll be worth less in the future. So why don't I spend dollars on digital rails? And that's what you're seeing is people are adopting this and they're saying, well, it's better to hold some cash than it is to hold my local currency because my local currency is losing value at even faster rate than the dollar. And so what you're seeing is the dollar and Bitcoin both rise together simultaneous, but you're seeing the local weaker fiat currencies all fall to the wayside. And so ultimately, what does that mean? Well, there's plenty of headlines talking about the de-dollarization and all these countries trying to get off the dollar and the BRIC countries and all this nonsense. The people are saying, I want dollars. And you see this around the world. And you look at, again, Tether, the latest numbers I remember are, I think they have 400 million on-chain users, and they're growing something like 30 million users per quarter. Mm-hmm. That is insane. Mm-hmm. But if you think about that, that's only approximately, 1/16 of the global population? They're not even at 10% yet. But the US dollar is nearly 50% of all global trade transactions. So there's this massive gap between the dollar usage and stable coins as the form factor for the dollar usage. And I think that gap is going to close over time. You're going to continue to see the dollar become more and more popular on the global trade perspective, but you're also going to see stable coins take on more and more of those transactions. And so it sounds crazy to sit here and usually talk about Bitcoin and be like shilling the US dollar. But I'm just looking at the data and I'm telling you that stable coins are going to become a bigger part of the market. The beauty is that that is very bullish for Bitcoin, because if I have electronic dollars in my bank account, for me to buy Bitcoin, I have to take those dollars and I have to move them somewhere outside of the bank. Let's say I go onto a crypto exchange. I have to go from dollars, wire it into a crypto exchange, then I have to turn that into a stable coin, then I have to buy Bitcoin. Well, if I sit with the dollars in Bitcoin, in a stable coin, I just press a button on my phone and I can change back and forth between dollars and Bitcoin. So what that does is when you reduce friction, it increases velocity. And when you increase velocity, that means more and more capital will end up in Bitcoin. That is where this world is going. And there's a whole lot of financial institutions who've been sitting on the sidelines, and now they realize we better get in the game.
Let's talk about the institutions sitting on the sidelines. So retail investors bought the dip and believed that the market would come flying back, while Wall Street stayed on the sidelines and continued to play defense. Now, while you were talking, I was trying to look this up really quick, and I still don't know what's going on, but what is happening with Open Door and this guy, Eric Jackson?
Let's talk about a retail investor.
Okay.
There is a thought process on Wall Street that the institutions are smart and retail is stupid.
Retail being individual people who
individual investors
buy stocks.
But retail is thought of as somebody who's like sitting in their mom's basement with $10 on Robinhood.
Okay.
And they don't know what they're doing and they're just punting the money around. Do some of those people exist? Of course. Is that the majority of the market when we're talking about retail? Not at all.
Today's episode is brought to you by Polkadot. Polkadot offers secure, scalable, and decentralized blockchain technology that perfectly aligns with the needs of innovative projects. It was developed by Gavin Wood, one of the co-founders of Ethereum and the creator of Solidity. Polkadot aims to build an internet where users have full control over their data and their applications. Polkadot offers tons of unique features, a shared security model, along with the new auction model and significant implementations like ASIC banking. Given these characteristics, it's easy to understand why Polkadot is gaining more and more traction in the cryptocurrency world. Some people even are talking about it as the AWS of Web3. Now, companies such as Mythical Games, Astor Network, and over 50 other independent blockchains with hundreds of applications already leverage Polkadot's technology to power their platforms. If you're looking for a reliable, scalable, and cutting-edge solution, Polkadot seems to be the top choice for industry players. Go check them out today at polkadot.com.
Today's episode is brought to you by Core. You can earn yield on your Bitcoin by just holding your Bitcoin. It's simple. Core, the leading Bitcoin scaling solution, will reward you for not selling your Bitcoin. It's not magic. Here's how it works. Core is a protocol secured by elected validators. You can help elect validators and secure the network by simply locking up your Bitcoin on the Bitcoin blockchain. No bridging, no lending, and just holding. When your validator secures Core, it earns rewards fueled by network activity and passes them back to you as yield. With a minimum lockup of just 1 day, when the time lock ends, you get your Bitcoin back untouched. Still your keys, still your coins, now your yield. For even higher rates, stake Core alongside your Bitcoin and multiply your yield. And if you want to see what your Bitcoin is securing, join millions of others in exploring the largest Bitcoin DeFi ecosystem. There are over 100 live apps in the network and the deepest liquidity in all of Bitcoin DeFi. Get off zero and start earning yield on even just 1% of your Bitcoin by going to stake.coredao.org/pomp. Again, that's stake.coredao.org/pomp, or go click the link in the description. Do some of those people exist? Of course. Is that the majority of the market when we're talking about retail? Not at all. What has happened over the last, I don't know, probably decade, but really I think has kind of exploded in the last 7 or 8 years, is the rise, not just of retail, but what I would consider and clarify as the self-directed investor. The way that the self-directed investor works is they go on the internet and they use X or Twitter, Reddit, podcasts, YouTube, newsletters, all that stuff, and they learn. And usually they are learning from other people who are putting money in the market. I write an email every single morning. I don't know if anyone actually learns from it, but I'm putting my personal views out there, and my views tend to align with my portfolio. And if I am right, I make money. If I'm wrong, I lose money. Then there's hundreds, if not thousands of other people, tens of thousands of other people who are putting all this information out there. So on Wall Street, one of the reasons why people like the Bloomberg terminal is because there's a chat function. I'll be sitting in there talking. And some of the chats, you can talk one-to-one. Some of them are like anonymous chats. There's all kinds of stuff.
I didn't know that. There's anonymous chats.
It's on like soap opera season or like finance. But X is the world's group chat when it comes to finance. You can go on there, and if you want, let's say you find a company and you want to find great analysis, type the ticker in on X and you'll find someone talking about it. Now, is it super obscure, small, $50 million market cap company?
Never mind.
Probably not. But there's all kinds of these amazing retail analysts. Now, here's what's interesting to me. If you get your information online, then you don't normally use your information source of the mainstream media. So already there's a direct connection. I don't need a reporter to tell me what the analysts are saying. I can just go read from the people who are publishing their work on the internet, whether it's podcast, YouTube, newsletter, tweets, whatever. Okay, so now I got my information. Now I'm more informed. As a self-directed investor, I have access to more source material and more material.
You have the source material and the material, but do you know how to analyze that source material?
You're reading, somebody else is doing the analysis. The same.
Who?
By the way, guess what happens on Wall Street? There's all these research, buy side and sell side research, et cetera. Somebody's doing a bunch of analysis. They're sending it out to people and they're trying to convince them of some viewpoint.
Yeah.
Same thing's happening on X. But the hive mind, the group or the power of the crowd is actually more valuable. So guess what people on Wall Street are doing now? They're sitting on X while they're sitting at their desk and they're learning as well. And so ultimately there's an idea generation, there's an analysis, there's all this stuff that's on. So now if I as an individual have access to more information, and I don't have to spend $25,000 a month on a Bloomberg terminal, then I am actually able to use that information. Now, what did I historically do? Well, I need to go to my stockbroker or my financial advisor. Now, all of a sudden, I don't need those people, right? Not because they're not helpful, not because a financial advisor can't help when it comes to estate planning or maybe getting me access to certain investments or maybe even just helping me think through how to create a portfolio. But in terms of actually executing a trade, I now have technology available where I can go direct to the market. So I may have direct access to the market and still choose to use a financial advisor for certain reasons. But increasingly, there's a group of people online who are informed by the internet and they directly access the market on the internet. They do not use the financial advisor. They do not use the stockbroker. So what does that mean? That means that you now have an entire generation of these people who are showing up in the market. They're sophisticated, they have money, and they are deploying that money. And so it goes back to this idea of retail. Well, why was retail right and the institutions were wrong in April? Remember, the stock market went down about 20%, is now up over 30% off the April lows. Institutions, hedge funds, financial institutions, all these guys are all sitting on the sidelines. Remember all the doomsday predicting? They had all their little spreadsheets and models and all this nonsense that they were all predicting the shelves were going to be empty. The Great Depression was coming. All this craziness. Guess what retail did? They said, I've seen this before. 5 years ago, the market crashed really fast and I bought and the market came back really fast. Buy the dip. And guess what retail did? We have the data. It's conclusive. They bought the dip and guess what? They were right. And the market came flying back. And people say, oh, because the tariffs are getting implemented. Right now, in the United States of America, there is a 10% blanket tariff on all U.S. imports. So this whole idea of like the tariff or whatever. No, certain countries, we had really big numbers and then we dropped them down. There's still like a 35% tariff or something like that on China. That wasn't there before. So just because there was big numbers and then we ended up in a different place, we absolutely have a lot of tariffs. Go look at the tariff revenue charts. They've exploded. We are collecting tariff revenue, right? And so the tariffs got put in place. The inflation didn't show up in the way people thought it was. There wasn't this doomsday scenario. Retail bought the dip and now they're getting rewarded for it because the stock market has come back in a major way. It's a 3-month historic recovery for the stock market. Never really seen this before in history. Institutions thought they were smart and they sat on the sidelines. So it begs the question, who is smarter? Do you want to be right or do you want to make money? And the retail investors, I'm not talking about the people who are punting on penny stocks and have $5 on Robinhood, and sitting in their mom's basement. I'm talking about the sophisticated, self-directed investors. They are making a lot of money. And guess what? If you go and you look at the distribution of ownership, retail was right about Tesla. Retail was right about Palantir. Retail was right about GameStop. Retail now seems to be right about Opendoor. Retail was right about Bitcoin. We can just go down the line. All of these different companies or assets where retail investors, they started to buy. Institutions were either negative or neutral. And then the institutions capitulated over time and eventually said, you know what, you're right. So if you go back and you look, why are there these cult followings around Bitcoin, around Tesla, around Palantir, et cetera? Because retail bought at very low levels. And then as the stock price or the asset price rose, they were making money. They got excited. If you bought Palantir and it was low, and now Palantir is high in the stock price, you love Palantir. You want to kiss Alex Karp. Your family is talking about how crazy you were to be buying the software company stock, and you're sitting there counting your pennies, laughing at them. Bitcoin, same thing. Tesla, same thing, right? Just go down the line. How about the early investors in MicroStrategy, now known as Strategy? How about the early investors in Metaplanet? You just go down the line. That's why these cult followings started, because people figured out that they front ran the institutions. And so it goes back to the idea. Does retail get it right every time? Absolutely not. Does Wall Street get it right every time? Absolutely not. No one's batting 1,000. But the major stories in finance of the last 7 or 8 years, retail has beat the institutions to those themes. Now, does that mean that the institutions are all sitting there with no exposure?
And hold
Absolutely.
on. Why do you think that's happened?
Because what you now are getting is you're getting a confluence of trends. You have access to information in a way that retail previously didn't have.
Right.
The second thing is that retail actually can take more risk because they're not managing other people's money.
Right.
One of the things that people don't understand about the traditional financial system and the firms in particular, and the hedge funds, et cetera, it's all a relative performance game. If everyone else is up 5%, you're content with being up 8% because you just beat your peers.
Yeah.
But if the market is up 20, are you actually winning, son? Right? And so what retail cares about is absolute return. I don't care what my peers are doing. I don't care about this. I just want to make money. And so it is a purer form of investing, in my opinion. There's not all these, we need to be risk mitigated. We need to have portfolio construction. I need to worry about my Sharpe ratio or my Sorrentino ratio, or I need to worry about this, or, no, I need to have this kind of custodian. It is pure, like what I would consider pure PVP free market. And that ultimately leads to better returns. They have capital. They can go anywhere. They can do anything. They don't have to report to anyone, and they can take maximum risk. Now, when most people hear risk, they say, that's scary. Well, if you're taking risk with a hedge fund because you're managing other people's money, now all of a sudden they really care about, what is your risk-adjusted return? They really care about what is the portfolio construction? What are your risk limits? What is this? But all the stuff, right? That's why these multi-strat hedge funds, like their goal is to return like 12% a year. If they can consistently return 12% a year, 13% a year, and do it with minimal risk, home run. Because the institutions, that's what they want. But the individuals, go out there in the street and talk to retail investors. If they got 12% a year, would they be happy? Hell no. Right? What they're looking at is they're trying to figure out, how do I create wealth? A lot of these institutions, a lot of these financial firms, they're trying to protect wealth, right? That's not what these people on the internet are doing. They're trying to create wealth. So what do? You run a more concentrated portfolio. You take way more risk. You're looking for more asymmetry.
You do take more risk. You
seek out more volatility. But I would argue the things that are positioned as the safest things in finance are actually the most risky. Holding bonds, losing strategy. Holding dollars, losing strategy. So you look at it and you say, the average financial advisor would go tell someone to create a 60-40 global portfolio. 40% of your portfolio is an L, right?
Because over time it gets devalued.
You just are getting crushed. What bonds in a traditional 60-40 portfolio, what are you going to go hold? TLT and just get your face ripped off, right? So what ends up happening is that you see an entire generation saying, wait a second, why would I put that stuff in my portfolio? Maybe I'll do 60% stocks, 40% Bitcoin. That's the type of stuff that you're seeing. So I think that there's this whole trend of these self-directed investors. So now it leads to Opendoor. When somebody says, oh, Opendoor is becoming a meme stock.
I knew it.
What?
Oh, no. I just thought that
it was becoming a meme
stock?
You just saw people talking about it online?
I was like 800%.
Well, here's what ends up happening. So I forget what the peak of Opendoor was, but it was like tens of dollars.
Yeah.
And it dropped all the way down to like 50 or 60 cents.
Yeah.
Destroyed from a stock price standpoint. And all of a sudden, there's this guy, Eric Jackson. I know Eric. He's invested in companies I've been involved with before. He has a hedge fund. That hedge fund uses, he'll say AI models. I don't know exactly what that means, but basically they're doing data analysis and they're looking for little signals in terms of what is likely to lead to future price appreciation. Mm-hmm. Now, in the Opendoor situation, my understanding is that this model picked up that there was a spike, an abnormal spike in trading volume of the stock. Started paying attention. Now, he previously, my understanding is, had been an investor and actually lost money, if I understand correctly, in Opendoor before. Mm-hmm. So he liked the story. He thought it could be a good business, but it kept falling, right? And he didn't work. He comes out and he says, well, hold on a second here. The stock is trading at 60 cents, let's say. And he said he thinks it can trade at $82. People are like, well, what? That's crazy. His point being that if you actually go and you look at the revenue and the business model, the cash, the debt, all this stuff, the business right now is not trading at a very big multiple compared to where he thinks it should trade. Okay, well, if you think that nothing has to change with the business, it gets repriced as long as people realize it's trading at such a low multiple. Plenty of people have made money doing that. But his point is if you look forward based on the company's guidance in terms of what they're going to do in the future based on revenue and profits, et cetera, then you assign a multiple that would be appropriate. That's how he starts to get towards this $82. Is he right? I have no clue. But you know what I do know about Eric Jackson? He's been right before. He's been wrong before. But there are enough times now where he's pointed to things and he has claimed that they were going to appreciate significantly, kind of this asymmetric thing. You know, he says that his focus is to find 100 baggers. Is Opendoor a 100 bagger? I have no clue. But I know that it went from 60 cents to whatever it was, $4 recently. And so from that standpoint, I think that you now get a bunch of retail investors and these self-directed investors, and they see some guy come out with this. Guess what it does? It brings attention. Then they start swarming. Some of them are buying merely because it's a meme stock. They just say, hey, I think this is going to be real exciting, very volatile. I want in on the game. I saw what happened to GameStop. I saw what happened to Bed Bath Beyond, blah, 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 whatever. Let's go buy. Some portion for sure. But there's also people who say, wait a second. They go and they read Eric's analysis. They say, you know what? I think he's right. I think that this is underpriced. And they go and they buy it. Now, you can't decipher the difference between those two people. Right? All you know is that there's a lot of buying. I think that they, one, they created a gamma squeeze. Two is they've now been halted multiple times this week in terms of so much volatility. And three is I think they smashed the trading volume record for Opendoor.
Wow.
But it's because you have the hive mind online. And once these people start to realize it. Now, one last thing I'll share. What I suspect is going to happen here is that the Opendoor team is going to say, thank you, Eric Jackson. We appreciate you bringing so much attention to our stock. Oh, all these investors, you guys are creating a lot of trading volume in our stock. Maybe we should raise money. Having more money on our balance sheet probably isn't the worst thing in the world. It may even help our business. And so I expect that Opendoor is going to raise capital, either through an ATM, some sort of a share registration, a private offer. They'll do something to convert the enthusiasm and trading volume into capital on their balance sheet. That's what they should do. But the question becomes, how many of these people are buying it and going to hold the stock because they believe that it needs to be valued higher? Or how many people are short-term speculators are going to buy it today and sell it tomorrow? My guess is that people are actually underestimating what I would consider more like real trends that are at play here versus people just thinking like, oh, this is some meme stock, whatever. I think that you're now starting to see that when somebody finds something, and in this case, it was a very heavily shorted stock, plus it had all of these elements to it. And they're able to yell and scream to the internet and say, hey, look what I found. You're now seeing people run over who are very sophisticated with a lot of money. And guess what? The financial institutions, they're not dumb. They've got social listening tools. They're looking at the conversation online. They're seeing the momentum. They're seeing the trading volume, all that stuff. You think that in the last 2 days, when we saw the stock go, I think it closed on Friday at like 220, 230 a share, to all of a sudden it was trading at $4. You don't think institutions were also in there? You don't think that they're plowing capital in right alongside retail? Of course, a lot of those portfolio managers, they're on the internet. They know what's going on, right? And so I think that that's where you're starting to see this graying of the line, where the institutions in some cases follow retail now because they realize that retail has the ability to do this stuff.
Right.
And we saw it with Bitcoin. Institutions are following retail. We've seen it with Tesla, Palantir, et cetera. And now we're seeing it with Open Door. And so I don't own any. I was very tempted to buy some just to be along for the ride. You know, if I had bought some Open Door and tweeted out $82 a share, let's ride, you know, that would have been a pretty good tweet. But I feel like if I want to be able to talk about this in a kind of a fair, may I say, balanced way, I shouldn't own any of the shares. And so I'm fascinated by this. And I think that the Open Door retail holders are probably, on a probability basis, they are more likely right than wrong. And
do you think that something like this, like if a company stock becomes a meme stock, is good for the actual business long term? Because I just looked up GameStop. It was trading at $1 in 2020 before the boom. And then it went all the way up to $50 in March of 21.
So retail was right.
And then it went back down, and today it's currently trading at $24, but it's still up from it's up
24x in 5 years.
Yeah.
And they have $9.5 billion on their balance sheet.
But it's important to say that it's risky and volatile.
And they got Ryan Cohen to come in and be the CEO. So you look at it, is GameStop better off today than they were 5 years ago? Hell yes. Retail did that. Now, here's the secret. Today's episode is brought to you by Bitcoin IRA. Are you a crypto investor with a retirement account but don't have any crypto in your retirement account? Listen up, this is for you. Bitcoin IRA is revolutionizing the way Americans save for retirement by helping smart investors diversify their savings with access to over 75 cryptocurrencies. With world-class customer service, military-grade encryption, and a vertically integrated licensed trust company, it's no wonder more than 200,000 Americans trust Bitcoin IRA to secure their financial future. Get started. It is quick and easy. It takes just 3 minutes to open an account. Once you're set up, their team of IRA specialists will reach out to guide you through every step of the process. Whether you're transferring an IRA from a legacy bank, rolling over an old 401k, or starting fresh with a new contribution, the Bitcoin IRA team is here to help you get access to real crypto in your retirement account. And here is the best part. As a Pomp podcast listener, you can earn up to $1,000 in rewards when you add funds to your account before tax day. Search for Bitcoin IRA in the App Store or visit bitcoinira.com/pomp to join 200,000 Americans on their journey to upgrade their retirement. That's bitcoinira.com/pomp to upgrade your retirement today. Is GameStop better off today than they were 5 years ago? Hell yes. Retail did that. Now, here's the secret. A bunch of institutions were also fueling the rally as well.
Yeah.
Right? What's the market cap on the business? If you look,
hold on.
Remember, they got $9.5 billion on the balance sheet alone.
Market cap. Hold on, I looked up share price.
If you look up the share price, you should see it right underneath on Google Finance.
Oh, it's 10.75 billion.
So think about that for a second. So they're valuing the business approximately at $1 billion, $1.2 billion, and they have $9.5 billion on their balance sheet.
Mm-hmm.
Okay, let's say the business is free. You get zero credit for the business. It's still a $9.5 billion company just based on its balance sheet assets, right? And so when you look at it from that perspective, that's the type of thing where it kind of doesn't matter about the business in the sense of they were able to raise capital and fortify the balance sheet. That company will likely never be in trouble. If I remember correctly, I think that they have something like $8 billion or $9 billion, whatever the number is, sitting in treasuries. Well, if you're earning 5% or 4% on treasuries, and you happen to be doing that on $8 or $9 billion, guess what? You're doing okay. You got a couple $100 million of revenue that all of a sudden came out of nowhere. Now they're profitable on a single store unit basis. There's still a lot of questions there. They're working hard, right? I've talked to Ryan Cohen about the business. One of the most interesting things to me, as a kid, GameStop, they sold video games. Right? You would go there, you could buy everything from a PlayStation, an Xbox, Sega Genesis for those of you back there, Nintendo 64, all those stuff, right? But they sold games for the most part. GameStop, great name. Now, guess what one of the fastest growing segments for them is? My understanding is that it's like Pokemon cards and stuff, right? So you start to figure out, like, again, he didn't say this to me, but I got to imagine Pokemon card, pretty small, pretty light, got a big store. It's easy to put in little places, right? Now on a per square foot basis, the revenue you could drive in the store probably increases. Like that's the type of thing where when you take a business, it's got a tension on it, you put capital on the balance sheet and you bring an entrepreneur in to run the company. Hey man, crazier things have happened.
That's true.
So if you look at it from that perspective, do I think Open Door will be better off for this? 100%.
Interesting.
It's just that the public narrative is, oh, look how stupid all these people are. You know what I always say? If the critics are so smart, why aren't they richer?
Let's see how it shakes out. But I want to talk about, it's kind of off of retail investor, but one type of investor that a lot of people don't take seriously, in my opinion, are athletes. Everyone's like, oh, athletes, they just like put their money, wherever people tell them, they don't really know what they're doing. But there's one exception to this. And I think now there's a lot, or not a lot. There's numerous exceptions to this. But one of them is Saquon Barkley, who's like the star running back for the Philadelphia Eagles. You see how I know that? He won a Super Bowl. And he used
Sports.
He used to play for the Giants when the Giants were good.
We know.
Okay.
You just have to throw the salt in the wound. Go ahead. All right.
It's okay. We're still Giants fans, right?
Well, I am. I don't know.
Oh, I don't know what I am. But Saquon has surrounded himself with some great people and some great advisors. Some great advisors. Anthony's friends with Saquon. They talk regularly. And he made news in 2021 because he said that he would take part of his marketing and endorsement dollars, use Strike to convert it to Bitcoin. And I think it was like $10 million, which today is worth like 36 million. So he just did an interview and they asked him if he regrets not putting his whole contract, taking his whole contract into Bitcoin if he could go back. And he goes, of course I do. Of course I would. But I think everything happens for a reason. And I'm glad I didn't because, it's volatile. I panicked a lot when went up and down and whatever. So I think that's interesting. Are you seeing more and more athletes doing this? Well,
first of all, the OG, Russ Okong, right? Russ will never get the credit he deserves.
He's great.
He was the pioneer of thinking through this. And the thing that I think people should give kind of Russ respect for, he didn't do it from a speculative standpoint. Right. He didn't say hey, I'm going to buy this or I'm going to take part of my contract in Bitcoin and I'm doing it because I got some crazy price target. Russ really understood the economics. Yeah. He understood debasement of the currency. And I think he'd be the first one to say he started out, he didn't know a lot.
He said he started off as a critic. He didn't believe. Yeah.
But then he started to learn. He did the work. He started talking to people, all this stuff, right? And at some point he gained the confidence where he said, I think that this is a long-term thing. And he's very family oriented. And I think that, he's never told me this, but I think that probably family played a big part into it. What do I want to do for my family in the future?
A lot of these guys talk about generational wealth, which plays into that.
If you are a young man, regardless of whether you grew up rich or poor, whether you went to public school or private school, whether your parents had some white collar job or blue collar job, whether you were born in the United States or not, what language you spoke growing up, any of that stuff, the athletic field is an equalizer. And if you are at the top of your game and somebody comes to you and says, I will pay you tens of millions, hundreds of millions. In some cases, some players have been able to sign contracts consecutively worth over $1 billion.
Wow.
Then you have a responsibility to say, I've been given this opportunity. I don't want to squander it. And there's story after story after story of people squandering it, right? And so now, again, with the internet, they understand I have the opportunity to create this generational wealth. And look, if you go talk to anyone who makes money, do they waste money? Do they buy dumb things? Or of course, they want to enjoy it. If you are a professional athlete at the top of your game, you think that you're not, spending money here, there, of course. Now, with that said, that doesn't mean that one of the very simple things that sports agents and financial advisors try to get through to many of these athletes is do not touch your contract money, live off of your endorsement.
Yeah. Yeah.
So all that contract money should be put to the side and let's invest it. And that is the nest egg.
Yeah.
Knock yourself out. You want to go to the club and throw $10,000 around, knock yourself out. You want to buy a Bugatti, knock yourself out. You want to do whatever you want with the endorsement money. Don't touch the contract money. And so I think that's what's starting to happen here. Now, Bitcoin, if you're a professional athlete, you tend to have a certain type of personality. You tend to be competitive.
Yeah.
You tend to want to win. You tend to all these things, right? And so from a personality standpoint, the idea that you can do work, practice, some may say, intellectually, learn something, figure it out.
Where you're not trading
else.
your body for.
Correct. Buy an asset that on a competitive analysis wins and outperforms all these other assets.
Yeah.
Not all of them, but a lot of athletes are drawn to it. And so I think that is also, by the way, why a lot of what I would call, Saturday athletes, not because they're playing college football, just playing with their kids in their backyard or whatever. No, just dads, moms, whatever, right? Just, Saturday athletes.
I'm more of a Sunday athlete.
Yeah. They're drawn to the same thing, right? If you're competitive, all this kind of stuff. So I think that it's just, again, it's the confluence of they have a need.
Yeah.
They have a certain type of approach. They put the work in, they get an answer, and they go and they do it.
I was recently talking to a former NFL player, and I was asking him whether some of this is the culture, it's now cool to talk about investing. And he said that it used to be in the locker room, you're talking about what apartment you bought or what kind of car, that was the cool thing. But now he's looking at your cap table or looking at how up you are on your investments, that's the cool thing to do. And I think it goes back to the competitive nature of a lot of these athletes. If one is doing it, the other one kind of wants to. Well,
it's competitive. They've all gotten smarter. Right now, the leagues also, they probably don't get enough credit. They've done a good job of explaining to these athletes when they come into these leagues, hey, there's a long history of people losing all this money, right?
Yeah.
Don't screw it up. And look, there's modern examples of it, right? I mean, how many times do we have to see a professional athlete file for bankruptcy or be in trouble, whatever, right? It's all that stuff still happens. But I think also take Russ, take Saquon, take, a lot of these athletes, they also probably don't get enough credit for sharing what they learn with their peers.
They really do. Although Saquon has said that a lot of the younger athletes don't go to him for,
Maybe they do, maybe they don't. I don't know. But it just feels like many of them are, they're willing to talk about it if somebody wants to listen, right? And I think that what you find again is whether you're a professional athlete, you're a janitor, you're a doorman, you're a taxi driver, you're a mid-level accounting manager, you're a finance person, or you're a tech bro. All of those different things end up coming back to one thing. It's an education and knowledge.
Yeah.
And if you can share education and knowledge, then ultimately what you're going to end up finding is that people who are informed will end up allocating their money directly in this rise of the self-directed investor. Mm-hmm. And Bitcoin is a big winner in that. But also there's a number of other assets where kind of quote unquote retail investor has been right. And institutions now are realizing maybe they should pay attention to what retail is doing. And whether it is Bitcoin, Open Door, or anything else, I think there's a lot of opportunity out there. And maybe the single most important aspect to me is we used to live in a world where it was thought that scarcity was dominant. There's not that much money out there. There's not that much opportunity to invest my money also. We live in a world today of abundance. There's money sloshing around the financial system. There are investment opportunities at every corner. And it really just comes down to, do you do the work? Right? I don't know that many people who got rich, who didn't inherit the money, right? By accident. And you can say I know a lot of dumb rich people. Sure. But sometimes the simplicity is actually the thing that works. And so from that standpoint, I think that's what you're seeing is these people are being successful because they are figuring things out that maybe otherwise they wouldn't have paid attention to previously.
Great. That's all we got today.
All right, guys. Thanks for watching.